Hey guys, and welcome to another new video. As you know, the property prices in Singapore for the past 2 years have been rising at quite a fast rate. So the government did introduce some cooling measures in December of 2021 in the form of lowering the loan to valuation of HDB flats from 90% to 85%, but apparently that is not enough to curb the market demand. So on 30th September at 12 AM, MAS, MND and HDB released a joint statement about the new cooling measures that is going to take effect immediately. So these new measures are aimed to promote sustainable conditions in the property market by ensuring prudent borrowing and moderating the demand. So these measures are targeted mainly towards the HDB market, but as you will see later, the private market will also be affected. So the first thing they've done is to increase the medium-term interest rate floor from 3.5% to 4% for private financial institutions to compute your total debt servicing ratio and your mortgage servicing ratio. So what this means is your total loan amount will be lower than before. I don't think that this is a cooling measure per se. This is just a measure to protect consumers who are buying properties in today's market, since the interest rates are slowly rising. So the government's stand is they don't want people to over leverage, to fork out more money than they actually can to finance the home purchase. So for housing loans from HDB, they are also introducing an interest rate floor of 3% up from the 2.6% that was previously used. But the HDB concessionary interest for HDB loans remain the same at 2.6%, 0.1% above the ordinary account interest rate. But here comes the big part. The loan to value limit for HDB will be dropped from 85% to 80%. This means that for the same price of a HDB flat, you will have to fork out a higher down payment. Furthermore, to moderate the HDB demand in the resale market, they will be imposing a 15 months wait out period for private property owners and ex-private property owners before they can buy a non-subsidized resale flat. So what this means is for private property owners who wish to cash out their profits and downsize to a HDB flat, they would have to wait 15 months after they have sold their private property to purchase a HDB flat. This means that within that 15 months, if they still plan to purchase a HDB flat, they have no choice but to rent a home or to live with someone else. However, this wait out period will not apply to seniors above the age of 55 who are moving from their private property to a 4-room or smaller HDB flat. So HDB says that this is just a temporary measure and will be reviewed in the future depending on the overall market conditions. So what this means for the HDB resale market is that there will be less cash-rich buyers who have just cashed out from their private property who are willing to pay a slightly higher premium for a HDB flat. So what they are expecting is this will cause a drop in demand, and the people who actually need and want to buy a resale HDB won't have to compete with those ex-private property owners who have just cashed out on their home. So the government also said that lowering the LTV for HDB flats do not really affect first-timer and lower income flat buyers significantly, as they may receive housing grants of up to $80,000 when buying a subsidized flat from HDB, or up to $160,000 when buying a resale flat. But I think it really depends on whether these measures are enough to cool the market down. So let's take a look at some numbers. So as you can see from this table here, let's assume that the price of the HDB flat has remained the same, $700,000 before and after 30th September 2022. So if you're a young couple looking to buy a resale HDB flat before 30th September, you would only have to fork out $105,000 of down payment, and you can take a $595,000 loan with a minimum income of around $9,000. But after the cooling measures, given that the HDB remains at the same price, your down payment would be $35,000 more, and you'll be taking a smaller loan of $560,000. But your minimum income required hasn't changed much, just $150 lower than before the cooling measures. So essentially, if your income has stayed the same and the price of the HDB has stayed the same, you can buy that HDB provided you can afford the increase in the down payment of $35,000. So because a lot of first-time home buyers are not really cash rich, they qualify for the loan, but it's quite hard for them to come up with the down payment needed. So if the measures do work and they manage to reduce the HDB resale prices by quite a bit, then I think it's quite fair for the resale buyers out there. But if the resale prices don't drop much, you're just making it super hard for first-time home buyers who are looking to buy a resale flat. And these people are buying the resale flats out of a need. Okay, next up, let's look at the private resale market. So how does the change in the interest rate floor affect your affordability for a private property? Okay, let's say that the price of the private property remains the same at 1.2 million before and after the cooling measure. Your down payment and loan amount of course will be the same since your loan to value is not affected like HDB. So assuming you are taking a 30-year loan, your minimum income required before the cooling measure is $7,348 to buy $1.2 million property. After the cooling measures, you need to earn around $460 more to buy the same property. So this is just to encourage more prudent buying, since buyers will actually be paying a higher interest rate in at least the next year to come. So overall, I do think that these cooling measures are quite reasonable, and hopefully they will be able to cool off the HDB resale market to make it more affordable for people who actually need to buy a resale HDB. If you have any questions regarding cooling measures or real estate in general, do contact me. My number is flashing on the screen now. And thank you guys for watching, and I'll see you in the next video. Bye!